ESG is no longer a just nice to have on corporate reports, okay? I think it's clear here. Investors, boards, and regulators are now pricing it directly into companies' valuations. If your financial models don't account for ESG metrics, you're underestimating risk and opportunity. And that's a gap finance teams cannot afford to ignore. Hi everyone, this is Diego and welcome back to my channel, The Clinic. Here we're gonna talk everything FP&A, corporate finance, accounting, insurance, everything related to the strategic side of finance. In the previous videos, we discussed ESG in finance, carbon markets, and how to integrate ESG into FP&A models. And today, we will go one level up and discuss how ESG actually impacts valuation and investment decisions. That's a really nice video. I hope you guys enjoy and welcome aboard. Now, why ESG metrics impact valuation? Here's the reality. ESG performance is no longer abstract. It directly impacts cost of capital. So companies with strong ESG often enjoy lower WACC, credit ratings. ESG risks can affect debt terms, investor confidence, meaning funds increasingly favor high ESG performers, and market multiples. Investors are going to pay a premium for sustainable, future-proof businesses. That's the reality. For example, studies show companies with strong ESG scores often trade at higher multiples because investors trust their management and long-term viability. So when ESG is ignored in your valuation models, you're essentially using outdated assumptions. So how to calculate ESG investment analysis? That's a really, really good question, okay? Finance can integrate ESG metrics in three practical ways. First being adjust financial assumptions, meaning CapEx for cleaner technology or retrofits, OpEx for compliance, reporting, or strategy efficiency, and regulatory costs and carbon pricing. These adjustments can change the projected EBITDA, free cash flow, and ultimately your net present value as well as your IRR. Second, risk scenarios, carbon price fluctuations, transition risk for high emission assets, supply chain disruptions or reputational risk. Use sensitivity analysis for scenario modeling to quantify potential financial impacts. That's what I would say. Third thing here, investment screening. Compare companies based on ESG scores or sustainability ratings. Integrate ESG adjusted assumptions into valuation models. And make investment decisions with forward-looking lenses. Okay? This isn't just being green. It's about quantifying financial risk and opportunity. Okay? Let's bring a case example here. I'll try to make it practical as usual. Let's see what I can get there. Imagine two manufacturing companies. Company A, a traditional operations, weak ESG performance, pretty much. And Company B, similar revenue, strong ESG, and low carbon footprint. At first glance, fundamentals look equal, right? But once you adjust for potential carbon pricing costs, investor demand for sustainable assets, which is a real thing nowadays, lower financing costs for ESG leaders. And then you go for Company B. Company B emerges as the more valuable investment. Even small ESG differences can translate into millions in valuation. That's the reality. It's cold, but it's true. ESG is no longer a side report. It's financial signal. Okay? Integrate ESG into your valuation, investment models, and strategic decisions, or risk being blindsided by market realities. In the next video, we'll cover how to report and communicate ESG metrics to the board and investors, so finance teams can turn sustainability into actionable strategy, which is key for us. Okay? So leave a comment if that's a topic you want to see next, and I'll make it happen. For the moment, thank you so much for enjoying this content. I hope you like, subscribe, and continue to participate down in the comments. And appreciate your time. Until next video. See you. Bye.